Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So big-time financial criminals love crypto. Just last year, just in 1 year, crypto was the payment method of choice for international drug traffickers who raked in over $1 billion through crypto, North Korean hackers who stole $1.7 billion and funneled that money into their nuclear program, and ransomware attackers who took in almost $500 million. The crypto market took in $20 billion last year in illicit transactions, and that's only the part we know about. You know, that is a lot of fentanyl and heroin, a lot of help for Iran and Russia, and a lot of money leaking out to terrorists. And that is precisely what anti-money laundering rules are designed to stop. Now, Mr. Reiners, you've studied financial technologies, including crypto, for many years now. And before that, you worked as a regulator. Why do drug lords and human traffickers in countries like North Korea and Iran use crypto instead of banks and credit unions or even Western Union?
Thank you, Senator. So crypto pseudonymity makes it ideally suited for bad actors. And when you couple that with the fact that crypto transactions are not subject to the same AML and countering the financing of terrorism.
AML meaning anti-money
laundering and the countering the financing of terrorism statutes that traditional financial transactions are subject to. Again, that just makes it ideally suited for people that want to do bad things.
So in other words, crypto helps those drug traffickers in rogue states launder money nearly instantaneously. Is that right?
That's correct.
All right. And if they couldn't use crypto, would ransomware gangs even exist?
No.
And why is that?
Because ransomware is the exclusive payment method of choice for ransomware hackers.
You mean crypto?
Oh, I'm sorry. Crypto is the exclusive payment method of choice for ransomware hackers.
100%. Wow. So we have money laundering rules that cover banks and credit unions and stockbrokers and gold dealers and even Western Union. But the current rules don't cover big parts of the crypto industry, and crypto likes it that way. In fact, the crypto industry claims that applying anti-money laundering laws to the whole crypto industry is, quote, not only unnecessary, but it's all but impossible. By the way, this is not a new claim. In 1970, Congress decided it was time for financial institutions to do their part to prevent money laundering, so it passed the Bank Secrecy Act, or BSA. The banking industry objected, claiming that complying would be, quote, a tremendous expense as well as a pain in the neck. The banks resisted. They brought legal challenges. They complained that it would be impossible to comply. And then after the law went into effect, they made it work. Now the crypto industry explains that they are amazingly innovative and creative, but they just couldn't possibly figure out a way to comply with the same anti-money laundering rules that everybody else follows. So, Mr. Reiners, do you buy the industry's argument that crypto is simply too special to follow anti-money laundering rules and that it would be too hard for them to even try?
I do not, Senator.
All right. Some in the crypto industry say that anti-money laundering rules can work so long as they exempt so-called decentralized entities, the crypto exchanges, lenders, and other financial intermediaries that run on code. In other words, they want a giant loophole for DeFi written into the law so they can launder money whenever a drug lord or a terrorist pays them to do so. Now, that is exactly what Colorado-based crypto exchange Shapeshift did when it deliberately restructured itself as a DeFi platform. And here's what it told its customers. They said, we're making this shift, quote, to remove itself from regulated activity. Translation, launder your money here. Mr. Reiners, should Congress be in the business of creating loopholes for money laundering?
They should not.
All right. Look, the rules should be simple. Same kind of transaction, same kind of risk, means the same kind of rules. And that's why Senator Roger Marshall and I are reintroducing our anti-money laundering bill to clamp down on crypto crime and to give regulators the tools they need to stop the flow of crypto to drug traffickers in places like North Korea and Iran. Thank you, Mr.
Thank you, Senator
Chairman.
Warren. Senator Haggerty. Warren.
Thank you, Mr. Chairman. Mr. Werfel, welcome. So for decades, Republicans in Washington have pursued a three-step plan to rig our tax system and to run up the deficit. Number one, shovel tax cuts to the wealthy and the giant corporations whenever they are in charge. Number two, slash funding at the IRS so that they can't take on rich tax cheats. And number three, pretend to care about fiscal responsibility when there's a Democrat in the White House so that the Republicans can hold our economy hostage. And let's face it, this scam has worked. The audit rate for millionaires has plummeted. And for years, corporations have contributed a declining share to national revenue to make this country run. And that's why the Inflation Reduction Act that Democrats passed last year imposes a new 15% minimum tax on billionaire corporations and provides the IRS with new funding to track down wealthy tax cheats. But the very first thing that the House Republicans did when they took power this year was to repeal the new IRS funding. So, Mr. Werfel, let me just ask, if that funding went away, would it make it harder or easier for billionaires to get away with cheating on their taxes?
Senator, I think it would make it harder. The goal is to increase the IRS capacity today to unpack these very returns you're referring to. So if the funding is repealed, we wouldn't have that lever to increase our ability to unpack those returns.
Okay, so in other words, if Republicans succeeded in repealing IRS funding, we'd have more billionaire tax cheats, and that sounds like it's going to cost us money. So let me ask the rest of that question. Mr. Werfel, would the Republican bill to defund the IRS increase or decrease the deficit?
It would increase the deficit. I typically look to CBO in terms of how they scored legislation. They scored the Inflation Reduction Act as a saver. So repealing
Meaning reducing the deficit.
Reducing the deficit. So if they repealed it, it would increase the deficit. I don't know the exact figure, but if I recall, they said it would increase the deficit by more than $100 billion.
Yeah, and actually the Treasury's estimated it will cost even more if we don't do this, about $400 billion. And then there's the latest Republican scam, the so-called fair tax. House Republicans plan to vote on this to slap a 30% national sales tax on everything that Americans buy, from gas to groceries to housing to health care. And at the same time, it would scrap all the taxes designed around people pay according to how much money they have. So, Mr. Werfel, how do sales taxes generally impact lower income folks versus how they impact the wealthy?
Sales taxes are regressive.
Meaning?
Meaning that they impact the low income in a more substantial way. They pay more. It's kind of a share of wallet. It's kind of, the more tax you have on a common good or services, a low-income person is going to feel that in their wallet more than a high-income taxpayer.
In fact, one analysis of the Republican tax plan found that average tax bill for the bottom 80% of Americans under this Republican plan would increase by 50%, while the top 1% would save hundreds of thousands of dollars on their taxes. And then just last little piece, the cherry on top, the Republican tax plan would completely abolish the IRS, make the states do the dirty work of increasing the price of everything by 30%. But I want to go back to the question about billionaires cheating. So if this Republican plan were in place, and billionaires buy and sell their mega mansions, their mega yachts, their private art collections, Mr. Werfel, would they have more opportunities to cheat on their taxes if the IRS were abolished and we had nothing but the Republican so-called fair tax law?
Senator, I think you're raising a good point. In this world that this act envisions, of where it's all sales tax rather than income tax, yes, you'd have very large, complicated transactions, whether it's a boat or a business. And if there's no IRS to make sure that we're assessing what the right sales tax is to pay, you would have a significant risk of evasion, I think.
Okay, so a tax plan that basically will cut taxes for billionaires and for billionaire cheats. I don't think there's anything fair about that. So I get it. The Republicans are going to make a lot of noise about the debt ceiling, but this is theater. The debt ceiling crisis is entirely made up. If the Republicans hadn't pushed through the massive Trump tax cuts and slashed the audit rate for billionaires, our country wouldn't even hit the debt ceiling in the first Biden term. Americans should not buy the Republican debt ceiling scam, and responsible lawmakers should flat out refuse to cut a single dollar of support for hardworking Americans while House Republicans refuse to help unrig the tax system. Thank you. Thank you, Mr. Chairman.
Thank you.
I recognize Senator Warren. Ransomware has hit everywhere. In the past 3 months alone, ransomware attacks have shut down 4 public schools in Nantucket, Massachusetts, affecting 1,700 students and their families. They've exposed the health records of over 3 million patients in California, and they have shuttered all 4 of Dole's food production plants in the United States, halting food shipments to grocery stores and disrupting our already vulnerable supply chain. That's just in the last 3 months. Let's do the last 24 hours. Just yesterday, we learned that ransomware attackers stole sensitive investigative information from the U.S. Marshals Service. Now, according to FinCEN, in the first half of 2021 alone, ransomware attackers likely received $5.2 billion, that's in half a year, in payments from American businesses, hospitals, school systems, and public utilities. Before 2016, the majority of cybercrime attacks involved small-scale credit fraud and bank fraud. Ransom payments ranged from about $75 to about $750. Today, the average ransomware attacker demands about $5 million. Now, Mr. Singh, you're an expert on international economics and national security. These large-scale attacks and large ransom payouts, would they be possible without crypto?
No, Senator. I think digital assets are central to the business model of ransomware.
Okay. And in fact, do you know what proportion of ransomware attacks are paid off by crypto?
Must be close to 100%.
They're exactly right. Right at 100%. The most active ransomware gangs are affiliated with or based in Russia, North Korea, and Iran. Now, Mr. Singh, does that put our national security at risk?
Absolutely.
So, thank you. In fact, in 2021, about 3/4 of all ransomware revenues, that's now measured in billions and billions of dollars, 3/4 of it went to Russia-linked ransomware gangs. In the years since Russia invaded Ukraine, Russian criminal organizations have doubled down on using crypto to hold American businesses, American schools, American hospitals hostage. Some have even declared allegiance to Vladimir Putin, vowing, quote, to strike back at critical infrastructures of Russia's enemies. And just last week, a Russia-affiliated ransomware gang called Black Cat attacked 13 hospitals in eastern Pennsylvania. So, Mr. Singh, I have one more question for you. You helped craft the sanctions that our country imposed on Russia and that you were just talking about with Senator Vance. You helped craft this in response to the Ukraine invasion. Is crypto allowing Russian ransomware gangs to extort American businesses and potentially evade those sanctions?
Senator, I don't believe it's allowing for the evasion of sanctions at scale, but even $1 of evasion is not something we ought to tolerate. And I think as I reflect upon the experience, one of the efforts we made in parallel was to launch the executive order on digital asset regulation and also trying to push our government to launch a digital dollar, which I think is the single best step that we could take because it would crowd out the ecosystem of crypto that allows national security adversaries like Russia to exploit our deficiencies, our weaknesses in terms of our critical infrastructure. And yes, I think to some extent, we won't know exactly for sure, to evade the impact of our sanctions.
So actually, let me just drill down just a little bit on this. In March 2022, FinCEN issued an advisory warning about Russian attempts to evade sanctions. The guidance said, and I'm going to quote, "Sanctioned persons, illicit actors, and their related networks or facilitators may attempt to use crypto and anonymizing tools to evade U.S. sanctions and protect their assets around the globe," end quote. And in September 2021, OFAC issued an advisory highlighting the sanctions risks associated with ransomware payments. And if I'm not mistaken, you were serving in the White House at this time. Do you agree with these statements from FinCEN and OFAC?
Yeah, I do.
Good. You know, crypto is being used to hold American businesses for ransom. It's being used to threaten American towns. It's being used to evade American sanctions. And it's being used to enrich America's adversaries. We have got to stop helping these guys by letting crypto go unchecked. Senator Roger Marshall and I are reintroducing our crypto anti-money laundering bill to protect our nation from ransomware attacks by stopping the flow of dirty money. It's something we need to do for our national security. Thank you. Thank you, Mr. Chairman. Homebuyers and veterans and people living with disabilities and families experiencing homelessness, you name it, we need more housing. So tax policies can be a way to address housing shortages. The low-income housing tax credit is not perfect, but it helps drive the development of affordable rental homes. But some of our tax policies may actually make the problem worse. Wall Street money managers have fanned out across the country, buying and converting what little supply of affordable homes remain, and they get tax breaks to do that. Ms. Scott, you are an expert on community development, so let me start by asking you about the impact of more Wall Street investors moving into the housing market. Big corporate landlords, often acting through investment vehicles known as real estate investment trusts or REITs, have bought up hundreds of thousands of homes across our country over the past decade. Now, some of these folks argue that REITs and other investors encourage investment in supply and neighborhood quality. Is that what you've seen?
Thank you, Senator, for this focus and your question. We're not opposed to
Make sure your mic's on.
Okay. We're not opposed to REITs per se, but we are very concerned about the institutional investors in the housing market and in our communities. We listed a research paper focusing in on New York City that you may have seen, that in certain instances when these investors acquire properties, they refinance them. So they're extracting money from the real estate and taking it out of the community rather than reinvesting it in the housing that they purchased. Oftentimes we find that the housing that has been purchased, the rents are increased, and there is the existing tenants may even lose their housing, they may be evicted. We see that maintenance, the quality of maintenance goes down, and overall there aren't the capital improvements. So, and on the single-family side, we see something similar happening where these investors are snapping up homes to rent at much higher rates than the market has generally supported. And so you see less opportunity for first-time home buyers. This is the stock, right? And so the community is being denied wealth. Wealth is coming out of the community, the housing is dilapidated, and oftentimes the institutional investors are not easily identified. And so it's not clear who the players are, where the money is coming from, and it's changing the face of many of our communities.
So that's a pretty grim picture about what's going on. And it's particularly alarming because in 2021, investors bought up 1/4 of all single-family homes that were on the market. And no surprise, the places where the biggest of these investors went, those that own thousands of properties, have been the most the places where home prices have increased the most. Now, these same biggest investors are collecting record profits while they are subsidized by government financing and tax breaks. So I just want to take a quick look at these tax breaks. Mr. Watson, we're going to be limited on time, so let's see if we can do these as true falses. You are an expert on federal tax policy at the Tax Foundation. Let's just talk about a few of the tax breaks that Wall Street investors have exploited to hoover up homes, make the supply crisis worse, and drive up costs for families. True or false? Many REITs are billion-dollar companies, including some of the biggest corporate landlords in the United States, Invitation Homes, American Homes for Rent, and Mid-America Apartments. But they generally do not pay corporate income tax if they meet certain conditions. Is that right? True or false?
They deduct it from their income, they would not.
True. Okay. So let's do another. The 2017 Tax Cuts and Jobs Act allows investors to deduct 20% of their pass-through business income, such as dividends they might receive from REITs. True or false?
True.
True. All right, let's keep going here. I like the way you're doing this. The CARES Act allowed all business losses to be carried back for 5 years. True or false?
That's true.
That's true. And that change resulted in billions of dollars in tax benefits that went largely to the wealthiest in the country, including Wall Street real estate investors. So let's do one more. Real estate investors can avoid paying taxes on profits from the sale of property if those profits are used to buy another property, a process known as like-kind exchanges.
That's true.
True or false? Okay. This loophole is expected to provide investors with a $134 billion tax break over the next 10 years. You know, I just want to say here, our tax policies reward giant real estate investors who raise fees, jack up rents, and evict families. Americans are already suffering from a severe lack of affordable homes, and any taxpayer money spent on housing should go toward fixing the problem, not making it worse. Thank you, Mr. Chairman.
Senator Warren, we'll have, because of her collegiality, we will have Senator Brown, then we'll have Senator Cortez Masto, and then we're going to wrap up because I have to deal with William Peter Wyden, age 15, in a couple of minutes. Okay, Senator Brown.
He must be a relative. Is he a relative? Maybe?
Yeah, son.
I knew that. And Senator Cortez Masto, thank you for your graciousness. Dr. Calabria, good to see you again.
Thank you, Mr. Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not
just
an
a math
intended
problem.
consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very
Just
very
looking
infrequent.
at the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this, and
There have been 12 times that we've seen a 1 point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that. But I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families, and if you're not going to lead that charge, we need someone at the Fed who will.
Senator Vance of Ohio.
Senator Warren.
Thank you, Mr. Chairman. So on Friday, the United States faced the second biggest bank failure in our entire history. And as panic spread among small businesses and nonprofits that had money deposited with Silicon Valley Bank, Treasury and other financial regulators announced they would take emergency measures to stabilize the system. I'm grateful for the administration's steady hand, but we shouldn't have had to be here in the first place. These bank failures were the direct result of policymakers' decisions over the last 5 years, beginning with a 2018 law signed by President Trump with the support of both parties to weaken the regulations that had been put in place after the 2008 financial crisis to ensure that big banks never again crashed our economy. On Monday, President Biden called on Congress and regulators to, quote, strengthen the rules for banks to make it less likely that this kind of bank failure will happen again, end quote. Secretary Yellen, thank you for being here today. Do you agree with the President that we need to strengthen our banking rules?
Well, I think we certainly need to analyze carefully what happened that triggered these bank failures and re-examine our rules and supervision and make sure that they're appropriate to address the risks that banks face.
Okay, so we want to make sure we've got the right rules in place. And pretty obvious we need some stronger rules here, so I want to talk about those rules, the stress test. Stress tests are critical tools in the regulatory toolbox that are designed to expose banks' vulnerabilities if bad things happen and force the banks to shore up any weak points before it's too late. Now, Secretary Yellen, when you were implementing the Dodd-Frank regulations as Fed chair 6 years ago, back in 2017, you said, quote, "Our stress testing regime is forcing banks to greatly improve their risk management and capital planning," end quote. But you warned that because, quote, "we can never be confident that there won't be another financial crisis, it is important that we maintain the improvements that have been put in place that mitigate the risk and the potential damage," end quote. So I want to talk about those stress tests that you talked about, how important they were 6 years ago. Secretary Yellen, can regular, rigorous, well-designed stress tests help bank regulators spot problems lurking in banks' balance sheets and business models?
Yes, I continue to endorse the comments
Good.
that you quoted. I think this has been one of the most important and consequential improvements in supervision since the financial crisis.
So,
But
two thumbs up for stress tests. Let me just ask, when regulators spot these problems early on, can those regulators then require the banks to clean up the problems long before they trigger a run on the bank?
Yes, and in that sense, they're useful, but I would like to make one point.
Sure.
Which is that the supervisory stress tests focus on capital.
Yes.
And not on liquidity. And in these bank failures, liquidity played an important role.
So let's ask the question then all the way around. If stress tests are done right, if we have robust stress tests, the way you described 6 years ago when you were still running the Fed, do they just test one thing that might go wrong, or do they test for lots of different problems if they're done right?
If they're done right, they test for many possible problems, but they do not focus on liquidity.
Okay, but they test
focus
for
on
many
capital.
kinds of things that go wrong. Is that right? Potentially.
Yes, there are different scenarios every year, and
So let me ask you then a related question. Is one of the problems that stress tests can expose is that you have managers who are not very good at managing risk, or management that is otherwise doing a bad job that could put a bank in jeopardy?
well, that's the purpose of supervision, and supervision, stress tests are one tool, supervision is another tool that's critical.
Okay, so
Focuses
very
on other
important.
things.
We've got stress tests, we've got supervision, we've got a lot of pieces here to make this work. In 2018, though, Trump's bank deregulation law and the door it opened for Fed Chair Powell to further hack away at the rules created an exception to annual Fed-administered stress tests, letting banks from $50 billion to $250 billion effectively off the hook. And that meant that a bank like SVB, which had $209 billion in assets when it failed, would be exempt from annual stress testing. So the question I have here is, if the law had not, let's not just do stress tests. It's stress test, it's the whole package. Enhanced liquidity requirements that ensure that banks have enough cash on hand to meet their obligations, particularly in times of stress, capital requirements that better position banks to absorb losses, regular resolution plans to help guide regulators safely through winding down failed banks. All of these were weakened in 2018, and when SVB failed, this is a part, in my view, of the Fed's actions that led to weaker regulation. You know, over the last few days, we've heard a lot of Republicans say that this collapse wasn't their fault. It was the banking regulators who were asleep at the wheel. And believe me, I have questions for a lot of the banking regulators. But Congress handed Chair Powell the flamethrower that he aimed at the banking rules. In fact, he said so himself, I'll quote and then I'll quit. When he announced that he was weakening regulations for the banks like SBV, Chair Powell said, and I quote, "In the rules before us, we are applying the discretion granted to us by the Economic Growth, Regulatory Relief, and Consumer Protection Act." Translation, Congress opened the door to weaker regulations, and I'm waltzing right through it. That's true. Congress needs to close that door. I'm sorry, Mr. Chair.
My colleague has great experience in this, and I apologize for having to cut people off. Senator Johnson's next.
Thank you, Senator Lummis. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So we just experienced the second and third largest bank failures in American history. Executives at SVB and Signature took wild risks and must be held accountable for exploding their banks. And I'll soon introduce a bipartisan bill to do exactly that. But let's be clear, these collapses also represent a massive failure in supervision over our nation's banks. So coming out of the 2008 crisis, Congress put tough banking rules in place. Now, big banks hated them, and their CEOs lobbied hard to weaken those rules. Ultimately, Congress signed off, and then it got bad, really bad. Regulators burned down dozens of safeguards that were meant to stop banks from making risky bets. Now, the three of you here today represent the U.S. Treasury and two of our top banking regulators. I'd like to know if you believe that we need to strengthen our banking rules going forward to ensure the safety of our financial system. Vice Chair Barr, let me start with you. Do you believe we should strengthen our financial rules going forward?
Yes, I do, Senator.
Thank you. President Biden agrees with you as well. 2 weeks ago, he stated that we must, quote, strengthen the rules for banks to make it less likely that this kind of bank failure would happen again. Chairman Gruenberg, what about you? Do you agree with President Biden that we need to strengthen our banking rules?
I do agree, Senator.
Good. And now, Under Secretary Liang, do you agree with the president on this?
Senator, I agree that we do need to prevent these types of bank failures.
Well, I'm asking you, of course we need to prevent them, but that's not by simply wishing it. It's by stronger regulation, is that right?
I agree, Senator.
Okay, good. Now, we need better laws here in Congress, but let's also talk about how we can strengthen the rules today, even before Congress acts. Under current law, the Federal Reserve has the discretion to apply stronger prudential standards on banks with assets between $100 billion and $250 billion, exactly the size of Silicon Valley Bank. That authority is not being used right now. Vice Chair Barr, will you use your authority to strengthen rules for the largest banks in this country as you use your authority to strengthen the rules for the largest banks in this country? Will you be reaching banks with assets of at least $100 billion?
Senator, we, of course, would need to go through a notice and comment rulemaking
I understand.
In this process, but I anticipate the need to strengthen capital and liquidity standards for firms over $100 billion.
Okay, so this is the area we're looking at. We're going to push down further in terms of the greater scrutiny. Chairman Gruenberg, let me turn to you. Once the Fed began torching rule after rule in 2018 for big banks, the FDIC, under your predecessor, joined in on the fun and also started weakening FDIC rules across the board. Capital and liquidity requirements, stress tests, you name it. In fact, your predecessor explicitly told these banks that if FDIC bank examiners were asking too many questions, that they should, quote, let us know, end quote. Now, there's a banking regulator who makes it clear that she is there to serve the big banks instead of the American public. Chairman Gruenberg, will you commit to using your authority to undo the rollbacks that your predecessor initiated and to strengthen the rules and supervision for banks with greater than $100 billion in assets?
Senators, I think you know I was a member of the board at that time and voted against those measures. And I certainly think it's appropriate for us to go back and review those actions in light of the recent episode and consider what changes should be
Well, I have to say, review sounds a little wishy here. You didn't think they were good rules to begin with.
My views haven't changed, Senator.
All right, so you still think they were a bad idea?
I do.
Got it. You know, each of you at this table has authority that you could exercise right now to strengthen rules for big banks and to ensure that our banking system and our economy are safer. I urge you to use that authority, and I urge my colleagues here in Congress to do our part to protect American families and small businesses from yet another banking crisis. Thank you, Mr. Chairman. So for years, lobbyists and anti-tax extremists have worked to gut the IRS to prevent it from chasing down wealthy tax cheats and to keep it from being able to help Americans who are honestly trying to file their taxes. But thanks to the Inflation Reduction Act, the IRS now has the resources it needs to make tax filing free and easy. This has been on the IRS agenda, their to-do list, for decades. Back in 2003, the IRS set up the Free File program, which was a partnership with companies like Intuit and H&R Block that was supposed to make filing free for 70% of taxpayers. But today, that Free File program serves just 2% of Americans. And that's because the tax prep companies sabotaged the program so they could keep raking in money, deliberately hiding Free File web pages from Google searches and confusing eligible taxpayers by marketing other fake free programs to them, only to scam them by collecting a fee later on. So let me start here, Commissioner Werfel. Do you agree that the current Free File program is a failure?
I agree. It's not reaching as many people as it should.
Yeah,
So,
the difference between 2% and 70%.
It's massive.
I think that's a failure. Tax prep companies have sabotaged the Free File program. They've tricked and trapped American taxpayers into paying for alternative services that should be free, that are marketed as free, but in fact, they don't make free. And the result is that today the IRS reports that Americans waste an average of 13 hours and $250 each year filing their taxes. And the Treasury Department analysts estimate that about 12 million low-income Americans miss out on thousands of dollars in refunds, likely because it is too expensive and too difficult to file through these supposedly free options. So, Commissioner Werfel, do you agree that the private tax filing options that companies are pushing instead of Free File is also failing American taxpayers?
The whole process needs to be improved. I agree. We need better clarity. When I hear the premise of your question, I think about the Taxpayer Bill of Rights, and just ticking off, 3 of them were violated just in your question in terms of the implication. So we have an obligation to make the tax system easier for taxpayers to navigate. And, you know, Congress hands us a very complicated tax code.
I understand that.
And we have to make it simpler. And so, yeah, I want to work with you and with this committee and with taxpayers to make that process easier. And if they are eligible for Free File and they're not taking advantage of that or are getting tripped up along the way, what can we do to help?
Okay. So, look, the Government Accountability Office, the National Taxpayer Advocate, Treasury Secretary Yellen, many of our colleagues on this committee all agree that it is high time for the IRS to develop its own truly free and easy way for hardworking Americans to file their taxes and to claim their refunds. And thanks to the Inflation Reduction Act, the IRS now has the resources to do so, including dedicated funding to develop a roadmap for direct e-filing options with a report to Congress due next month. Now, I'm looking forward to the report. You don't have to say here what it's going to do. I know we'll have an opportunity then to talk more about the specifics of what the IRS can do to help tax filers. But broadly speaking, Commissioner Werfel, can you explain why offering free and easy way to file directly with the IRS would help American taxpayers, particularly low-income and middle-income families?
Yeah, again, as you said, we're issuing a report by congressional mandate in mid-May, and that will walk through a lot of the issues. I think one of the goals that we have at the IRS is to increase the options that taxpayers have to engage with us. If they want a fully digital, they should have a fully digital. If they want to do it in paper, we're not thrilled with that, but we have to meet taxpayers where they are. And if they want to come directly to the IRS versus working through a third party, we now have the opportunity to study that and tell Congress what the implication of that is. As a guiding principle, the more workable options, the better. But because Congress asked and has legitimate questions about the issues associated with the direct file program, we're going to answer them, and then I'll come back in mid or late May, and we can talk through what the report said.
Well, I look forward to that. I think it's clear, though. Americans deserve an IRS that ensures that folks at the top pay what they owe, and that honest, hardworking Americans can file their taxes without spending an excessive amount of time or a lot of money to get that done. And I think that's where we're aiming. Thank you. Thank you, Mr. Commissioner. Thank you, Mr.
Senator Warren of Massachusetts, when she sits down, is recognized for 5 minutes.
Thank you, Mr. Chairman. So the three of you who are testifying here today are the CEOs of the largest credit reporting bureaus in the nation. Your companies determine the credit worthiness of just about every person in our country. And you make money by collecting and selling information about an individual's past success in repaying their debts, the amount of money that they owe, and other factors that you claim predict the likelihood of repaying their debts going forward. So credit reports that you produce have big consequences for people's lives. If someone's credit report drops by, say, 25 points, they could have a rental application turned down, they could be charged a higher price for a car loan, they could pay more for insurance, or they could even miss a chance at a new job. So it is really important that the data is right. Last year, over 100 million Americans had medical debt. CFPB research shows that medical collections are less predictive of consumers' future delinquency rates than non-medical debt collections. And research by FICO finds that medical collections that have been paid, this one really gets me, the ones that have been paid are even less predictive of consumers' credit worthiness than unpaid medical collections. So, Mr. Begor, you are the CEO of Equifax. Do you agree with the research showing that medical debt collections are not as good at predicting the likelihood of default as other kinds of debt like car loans, mortgages, and the like?
Medical debt is a very complex topic, Senator. A lot of medical debt isn't taken on willingly by consumers, so we appreciate the complexity of the medical debt as a complex
that's not the
process.
question I'm asking you. I understand that it's complex. The question I'm asking is its predictive value compared with, say, car loans, mortgages, and paying the rent.
It still has a predictive value, but the Senator knows that we took a proactive action to exclude medical debt under $500, as well as excluding
I
paid
understand what
medical
you've
debt.
already done. I'll ask my question for a third time. Is it less predictive than other forms of paying your bills?
It's still a predictive element in paying bills.
Is it less predictive than other forms of paying your bills?
I don't have that information available to me.
You don't
how
have
predictive
that
it is.
information available? Are you kidding me? You are the head of one of the biggest credit reporting agencies in the country, and you don't know the relative predictability of one of the major forms of debt that you report on?
Senator,
Really?
you
You expect me to believe that?
Senator, as I said, we still believe it's predictive. We're continuing
That
to
was
look at it.
not the question. If you can say that it is predictive, then I am shocked that you don't know how predictive it is compared to other forms of debt collection. Look, the reason that medical debt is a poor predictor of credit worthiness is our medical system is a mess. Most hospitals charge you one price, they charge insurance companies another. So medical bills are often a moving target. Bills are routinely sent to the wrong party. Often a patient can't even figure out what it is in terms of supplies or services that they're being billed for. Studies, which I assume you would have read, show that as much as 80% of medical bills contain errors. The CFPB found that, quote, many medical bills reported on credit reports are disputed, inaccurate, and not owed, end quote. Some debt collectors have even stopped reporting medical bills to your companies because the data is so bad that they worry that they may be violating federal consumer protection laws by reporting it. Last year, your companies made changes in how you handle medical debt, and those changes were good, but you fixed roughly about half the problem. Nearly half of the roughly 38 million people with medical debt on their credit reports will be left in the same position as if your companies had done nothing. The CFPB has said that it will continue to assess whether unpaid medical debt should remain on Americans' credit reports at all. So, Mr. Begor, let me ask you this. If the CFPB were to conclude that data on medical debt is so full of errors that it doesn't belong on credit reports, would you support all credit reporting agencies removing it entirely?
We're certainly prepared to collaborate with the CFPB.
That's not the question I asked you. Do you want me to repeat the question?
No, that's not necessary, Senator. We'd certainly support that.
All right, thank you. Mr. Cartwright, what about you? If the CFPB concluded that this data was so problematic that it doesn't belong on credit reports, would TransUnion remove medical collections from consumers' reports?
Senator, we would work with the CFPB.
That's not the question I asked. I'm not asking you whether or not you want to work. I'm saying if they conclude that the data is so problematic that it does not belong on credit reports, would TransUnion remove those data from consumers' reports?
Senator, to be clear, the CFPB is our regulator, and if they were to direct us to remove the remainder of information, because the actions we've taken voluntarily have removed 70% of consumer debt from the record, but if they directed us to do so, we of course would comply.
All right, but I asked you a different question. The question I asked you is just a factual one. If they conclude that the data are so bad that they should not be listed on credit reports, I'm not asking whether or not if they go ahead and put an order in place. If you had that information, Mr. Begor claims not even to know how bad medical debt reporting is. If you had that information from the CFPB, would TransUnion stop reporting it?
Senator, we are committed to accurate and complete credit reporting of predictive.
So if the Federal Consumer Protection Agency said these data are so inaccurate they should not be on credit reports, would you then remove them from the credit reports? It's a simple question, Mr. Cartwright. If you had this information from a federal regulator, would you use that information in order to get rid of this data, take it off the reports?
We would certainly act appropriately, and Senator, in the circumstances
I'm
that you
asking
outlined.
you're the CEO. Is it appropriate then to just take it off?
Yeah, I find it difficult to believe that the CFPB wouldn't issue guidance on the matter if that were indeed
So you're going to wait for
their
it to
analysis.
be ordered. That's what you're saying? You don't do anything unless you're ordered to do it?
What I'm saying, Senator, is that we are a data-driven analytic company.
I'm past my time. Let me turn to you. Would you support removing medical collections
Well, thanks,
from
Senator.
Experience Credit Report if the CFPB concluded that the data were so problematic they should not be on credit reports?
I understand the nuance of your question. I think first point I would say is if the CFPB directed to us, of course we would comply with that. If the CFPB concluded that it was so problematic and that the industry also agreed that there wasn't an issue in removing that data from credit reports, then we would do so too. But I think it is a complex issue, Senator, and I think it needs to be looked at in the broad.
You know, I apologize to the chair for running over, and I understand that the credit reporting agencies are just the last link in a very problematic chain of actors that hospitals and health systems and insurance companies and medical credit card issuers are all profiting from a business model of bogus and even illegal healthcare charges. And I'd like to see those CEOs in front of us as well. But credit reporting agencies are the ones who turn all of that bad data into real pain for American consumers. You're the ones who cost them real money, more than just those bills, in every part of their lives. And it is time to start holding every link in this chain accountable, and that includes the credit reporting agencies. Thank you, Mr. Chairman.
Senator Brett is recognized for a second short.
So America is facing a mental health crisis. 1 in 5 Americans live with a mental illness, and for Medicare beneficiaries, it's 1 in 4. Federal law requires Medicare to cover mental health services in both traditional Medicare and Medicare Advantage, or MA, the program that allows private insurance companies to offer Medicare coverage. Now, unlike traditional Medicare, the private insurance companies in Medicare Advantage can establish networks to restrict the doctors or facilities that beneficiaries can use. So if your doctor is in network, the plan will cover those services for a small copay, but an out-of-network doctor can leave patients with skyrocketing costs. This can be especially devastating for seniors or for people with disabilities who are more likely to be living on fixed incomes. To help beneficiaries avoid these surprise costs, MA plans are required to publish directories which enrollees can use to find new doctors or to make sure their existing doctors are covered. So let's start with what we know about the accuracy of these directories. There have been some references to them, but Ms. Gilberti, did I say it right, Ms. Gilberti? What do we know about the accuracy of the provider directories in Medicare Advantage?
So CMS has done some audits, Senator, and what they found was on average, the accuracy rate was about 45%. So,
what does that mean that the accuracy rate is 45%?
You know, they found in 2018, I think it was, almost 50% had at least one inaccuracy. So, we're seeing a good deal of inaccuracies. That's with physical health care. Just say there's a gap in data because they haven't done this for behavioral health yet.
And might we surmise that behavioral health
it's
accuracy.
Worse. It's always worse.
It's always worse. It's always worse. Okay, so you think you've got a list of people you can go to, and the odds are actually in favor of the list is wrong, and probably even worse on behavioral health. All right, so here we've got a patient who does everything right. They still may be hit with a huge bill because a directory has outdated or inaccurate information, or they might call up every doctor only to find out that we've heard about some of this. The phone numbers don't work. They're not accepting new patients. I think we've heard the story about this and appreciate your being here to talk about your story, Ms. Myrick. We know that MA plans use all kinds of tricks and traps to squeeze more money out of Medicare. They've got a lot of different ways that they do this to boost their numbers. But here's the one I want to focus on. Do these MA plans stand to gain anything from having inaccurate information? In other words, is it inaccurate because they just haven't spent enough money to make it accurate, or is it inaccurate by design?
Well, I think there are advantages that they have when their directories, unfortunately, are inaccurate. If they use those directories for network adequacy standards, for example, they might meet the standards, but they're not accurate. People make choices based on what they see as their network. So if it looks like a bigger network, but it's not real, people are choosing a plan.
Okay, so it's a way to defraud consumers. To say, I have this really big list of people you could go to if you had a problem. And it turns out that really big list, if it were accurate, is actually this little tiny list, right? Okay,
right. And then,
so that's one way. It's to the advantage of the Medicare Advantage plan in order to be inaccurate. They get paid, in effect, or they make more money by being inaccurate. Did you have another one?
Well, just that, I think it's about 60% of the plans don't have out-of-network coverage. So if you get really frustrated and you pay on your own, then they're not paying anything.
So the more I can frustrate you, the more that meaning the Medicare Advantage plan, the more the Medicare Advantage plan can frustrate you, the more you'll just go somewhere else. And that means it's not money out of their pockets. Did we get the two main ones you wanted to add?
I just was going to add, Senator, this is, yes, we see this all the time. This is health plans delaying and denying care. That same patient, once they finally find the needle in the haystack and even get to a physician who's in network and sit down and get a diagnosis and a treatment plan, then goes to the pharmacy and discovers the health plan requires prior auth for the treatment for that condition, which then it takes weeks to get approved. Sometimes they never go back to the pharmacy, they give up. Their mental health or their other chronic condition gets worse.
So conditions get worse and they don't have to pay for the treatment, this Medicare Advantage plan. So look, what we're really saying here is that it is in the financial interests of these Medicare Advantage plans to discourage beneficiaries from accessing care. We also know that the Medicare Advantage plans are paid a set amount per beneficiary, which can be dialed up if the beneficiary is sicker. So the more diagnosis codes that a beneficiary has, the higher the payment. The insurance companies have built entire businesses around making these beneficiaries look as sick as possible and then overcharging taxpayers by hundreds of billions of dollars. Because here's the key that underlines this. Whatever insurers don't spend on care as a result of tactics like outdated provider directories or overly restrictive networks or inaccurate information, whatever they don't spend on care, they get to keep. So let me ask you one last question on this. What penalties, Ms. Gilberti, do MA plans face for being out of compliance with regulations in provider directories and network adequacy? So we got a bunch of rules. When they're in violation of the rules, what's the consequence?
I'm not aware of any penalties, Senator. The audit that I mentioned earlier talks about like notices of noncompliance and warning letters, but they don't mention anything about penalties. So I know there's been some legislative proposals to that effect, but I'm just not aware of any penalties that are being assessed.
I tell you, nobody's jumping in with any other answer. You know, this is the part that just drives me crazy. People look at the regulation, they think, oh, well, we're going to be okay because this is regulated. But we're not okay if there's no enforcement. Now, to the extent they have enforcement tools, CMS really needs to step up the enforcement here. At a minimum, beneficiaries should not be on the hook for out-of-network costs that were incurred because of inaccurate directories. That'd be a nice starting place on this. CMS should also penalize Medicare Advantage plans that are out of compliance. Just put penalties on these guys. And it's Congress's job to put tougher regulations in place. And I also want to say this. If these Medicare Advantage plans continue to mislead beneficiaries about covered providers at the same time that they are overcharging taxpayers for this crummy coverage, then we should be taking another look at whether or not MA plans should continue to enjoy the privilege of restricting provider networks at all. Now, there's a serious question that should be on the table. If they can't do better in managing these restricted networks, then maybe they ought to have to cover anyone who's a licensed practitioner that you go to see. So with that, I will now say I'm finished.
After member talks about how we've got to be more competitive, you walk back, a very important tool. So I appreciated your leadership, and we're going to get this done. We're going to find a way to make it happen. Senator Warren, you're next.
Thank you, Mr. Chairman. I want to follow up on the questions that Senator Menendez asked just from a little different perspective. Today's hearing is about the tricks and traps that giant drug companies use to evade taxes that occurs against the background of a looming debt crisis. So Republicans in Congress are saying they're going to trigger a default if they don't get to slash vital programs that help families all across this country. For decades, Republicans in Washington have pursued a three-step plan to rig our tax system and jack up the deficit. Step one, shovel tax cuts to the wealthiest individuals and corporations. Step two, slash funding for the IRS so that it can't catch rich tax cheats. And step three, whenever there's a Democrat in the White House, use the debt ceiling to hold our economy hostage. Now, Republicans pretend to care about fiscal responsibility, but the last time they were in charge, they pushed through tax cuts for the wealthy and rewarded big pharma and other multinationals for offshoring jobs and profits. Professor Ring, what impact did the 2017 Republican tax bill have on the deficit that the House Republicans now claim to care so much about?
So CBO scored the 2017 Act as increasing the deficit by $1.9 trillion.
$1.9 trillion. Okay. Because the Trump tax cuts allow giant corporations to pay a lower tax rate than teachers, firefighters, or nurses, our debt ballooned by nearly $2 trillion. So Democrats have fought back. The Inflation Reduction Act that Democrats passed last year imposed a new 15% minimum tax on billionaire corporations, and it provided the IRS with long overdue funding to track down wealthy tax cheats and make them pay up. So, of course, House Republicans are now demanding that we once again gut the IRS, or they're going to trigger a catastrophic government default. Professor Ring, how would the House Republican plan to claw back IRS funding and protect wealthy tax cheats affect the deficit?
So CBO has scored that clawback as increasing the deficit by $120 billion.
Wow. So they want to increase the deficit. And for the cherry on top here, do you know how they'll pay for that $120 billion in increased tax cheating for their wealthy buddies? By kicking 21 million of the poorest Americans off Medicaid, food stamps, and other assistance. That's not all. On the same day that House Republicans passed their disastrous debt ceiling hostage demand bill, Roll Call reported that they are still working to try to extend the 2017 tax giveaways, with plans to unveil a bill this month or next to extend loopholes that big corporations use to drive their tax bills down to nothing. And that would apply to big tech, to big pharma, and to big banks. So, Professor Ring, how much would doubling down on the Trump 2017 tax giveaways to the wealthy and the largest corporations cost our nation?
So I haven't seen any of the specific tax bills that you are referencing, but CBO scored the cost of making TCJA permanent at nearly $3 trillion.
Wow. So increasing the deficit, right, by $3 trillion. So
increasing.
Yes. Even House Republicans who are now, they pretend to care about fiscal responsibility, but they are working around the clock to try to extend the tax giveaways for their wealthy pals, which is what got us into this mess in the first place. Congress needs to pass a clean bill to avoid default. The United States government does not default on its obligations. And as for budget proposals that would reduce the deficit, let's start by closing loopholes for tax-dodging, offshoring corporations, and let's make billionaires pay their fair share. President Biden has proposed a budget to do just that, raising enough money to make critical investments in affordable housing and childcare, while also reducing the deficit by $3 trillion. That is the kind of responsible economic policy that we need in this country. Thank you, Mr. Chairman.
I thank my colleague. We may have one or two other members coming, so don't think I'm just filibustering here to keep you in your seats.
Thanks, until Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman, for holding this hearing. You know, the last time this committee received testimony from Mr. Becker, the CEO of Silicon Valley Bank, he was lobbying Congress, us, to do away with the Dodd-Frank rules designed to protect our nation's banking system. Now, unfortunately, too many people in Congress listened, and now here we are, 3 bank collapses later, picking up the pieces of Mr. Becker's successful efforts at deregulation. In recent reviews of the failures of SVB and Signature Bank, Regulators found that weakened bank rules helped cause this crisis. They also found that each of the witnesses here today were repeatedly warned that their extreme risk-taking was dangerous. Now, instead of paying attention to those warnings, Mr. Becker, Mr. Shea, and Mr. Howell took on more risks so they could boost their own paychecks. Mr. Becker, you were SVB CEO from 2011 until it failed in March. In 2019, the year after Congress gave you what you wanted and voted to weaken the banking system's guardrails, you got a 35% pay bump. Not bad for a single year. In fact, your pay increased by nearly $3 million. Now, that same year that you got the pay bump, nearly 5 years ago now, how many active supervisory issues had the Fed identified and warned your bank about?
Senator, I don't recall the specific number that we would have had in 2019.
Well, you ran the bank, Mr. Becker. Do you want to take a guess? 1, 2, a dozen?
I would guess it would be in the 10 to 15.
Well, 17. Same year, you got a $10 million paycheck. The Fed had warned SVB of 17 unresolved supervisory issues. Now, your bank had issues with capital planning, it had issues with liquidity risk management, and the bulk of the issues identified by the Fed focused on weak governance. It was a litany of management failures. By the time SVB failed, more than 4 years later, it had 31 unresolved. That's what the public record shows. 31 unresolved supervisory issues. But the big paychecks for you kept rolling in. During that 4-year period, you collected almost $40 million. Mr. Becker, the collapse of your bank cost the FDIC fund about $20 billion, money that someone is going to have to make up. Big banks, community banks, depositors, consumers, somebody. So I want to know about basic accountability. How much of the $40 million that you earned from loading up SVB Bank with risk are you planning to return to the FDIC?
Senator, if I could clarify one point, and then I'll answer your question. Compensation, I know there's been a lot of discussion about is it long-term or short-term, and it's short-term focused.
I have a very simple question. You cost the FDIC fund $20 billion. You made $400 million doing that. How much are you planning to return to the fund?
Senator, I disagree with the number you just quoted, but
what, you don't, that's not your paycheck? Or it's not how much it costs the FDIC? Those are both a matter of public record. How much are you planning to return to the fund?
Senator, the number you just quoted was $400 million.
$40 million, sorry, $40 million.
I was disagreeing with that.
How much of the $40 million are you planning to return? How many times are we going to do this dance?
Senator, I promise to cooperate with the regulators as they do.
Are you planning to return a single nickel to what you cost the fund?
Senator, I know there's going to be a process review of compensation.
I'll take that as a no. All right, so let's turn to our next one, Mr. Shea. Mr. Shea, Signature Bank's leadership was right there with Mr. Becker. Mr. Shea, you were the chair of Signature's board for the entirety of its 22-year existence. I understand you were also the chair of the Risk Committee for 22 years. So let me ask you, in 2019, once Congress weakened the laws, how many formal warnings from the FDIC about your bank's liquidity risk management issues were outstanding? Don't know? Does number 18 sound right?
Yes.
Yeah, okay. In fact, you were still chair of the Risk Committee in 2020, 2021, and 2022 when Signature received more warnings from the FDIC and, quote, never adequately addressed the liquidity risk management concerns. So from 2019 to 2023, while the FDIC identified an additional 45 liquidity risk issues, you racked up more than $20 million in pay. So, Mr. Shea, The collapse of your bank cost the FDIC fund $2.5 billion. So how much of the $20 million that you earned from loading up Signature Bank with risk are you planning to return to the FDIC?
I believe that Signature Bank was a responsibly managed bank, solvent until the end.
Yeah, well, I'm
And the
sorry.
answer
Your
is,
opinion on
I
what
am
is a
not.
responsibly
And the
managed
answer is
bank
no.
is now laughable. So you're planning to return how much?
The answer is
None. That's
I
it?
am not planning to do so, no.
Okay, so here's the thing. Right now, the law says that people like Mr. Becker and Mr. Shea can come to Washington, they can lobby for weaker bank regulations, they can load up their banks with risk, they can pay themselves tens of millions of dollars in bonuses and stock options, and when the banks blow up, Mr. Becker and Mr. Shea get to keep all the money. And that is just plain wrong. And if we don't fix it, every CEO for these multi-billion-dollar banks will keep right on loading up on risks and blowing up banks, and everybody else is going to have to pay for it. And that is why Senator Cortez Masto and Senator Hawley and Senator Braun and I have introduced a bill to claw back these crazy paychecks and make it just a little less profitable for bank CEOs to blow up the banking system. I'm working with a bipartisan group right here on the Banking Committee, and I hope Congress does the right thing and that we get to mark this bill up, I ask respectfully, as soon as possible.
Thanks, Senator Warren.
Thank you.
Expired. Senator Vance of Ohio is recognized.
Thanks to the chair.
To pay. Thank you.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So earlier this month, when First Republic Bank collapsed, multiple banks were interested in buying the failed bank. Banking regulators chose J.P. Morgan Chase, America's biggest bank. The result was that a gigantic, poorly supervised bank was swallowed up by an even more gigantic bank, and now the biggest bank in the country is about $200 billion bigger than it was before. So in order for the deal to go through, two separate regulators had to sign off. When the FDIC sells a failed bank, the law requires it to choose the highest bidder that will result in the lowest cost to the deposit insurance fund. But the law also requires sign-off from the OCC. And the OCC's job, by law, is to consider whether the merger would pose, quote, risk to the stability of the United States banking or financial system, end quote. Acting Controller Sue, OCC regulations include a list of factors that the OCC must consider when evaluating, quote, risk to the stability of the banking system. Do you know the first item on that list?
It relates to the financial stability, whether there's a threat to financial stability in the U.S.
Whether or not, and what is the item you're supposed to consider? The very first one on the list.
I believe it is whether the merger will have financial stability impacts.
Because of?
Because of the merger.
No, it's whether the proposed transaction would result in a material increase in risks to the financial stability due to an increase in the size of the combining institutions. It troubles me that you don't remember this. So how do we know if a purchasing bank poses more or less risk to the banking system? Well, one metric that regulators use is the GSIB score, which estimates the impact on our financial system of the failure of each of our largest banks. The size of the bank is a big factor in its GSIB score. So let's look at the GSIB scores and figure out if JP Morgan, according to the OCC's own analysis, presented more risk to the banking system than the other bidders that have been widely reported in the press. So PNC tried to buy the failing bank, but you approved JP Morgan instead. Acting Controller Sue, is the GSIB score for JP Morgan bigger than the equivalent score for PNC?
It is.
How much bigger?
I don't know the exact magnitude of it off the top of my head.
Do you want to make a guess?
It's bigger.
8 times bigger? Does that sound right? Yeah. Let's take a look at another bidder, Citizens Bank. Is JP Morgan's GSIB score, that is the score that shows risk to the banking system, bigger than the score for Citizens Bank?
It is.
How much bigger?
Significantly bigger.
14 times bigger?
Perhaps. I don't know the exact scores in front of me.
Controller Sue, your job by law is to determine risk to the system from making big banks even bigger. And you have a clear metric for doing that, the GSIB scores. So how do you explain approving a sale to a banking giant that increases the risk to the banking system by somewhere between nearly 800% and 1,400% more than selling to other bidders? Did you just ignore the fact that a failure at JP Morgan would blow a hole in our banking system that would be 8 times more than the destruction to the financial system and let them grow by $200 billion?
Senator Warren, for every merger application, we follow the law, we follow our guidelines, we follow our policies and procedures. Under the financial stability prong of the Bank Merger Act, there are a number of factors. You named one. Had we followed a strict GSIB score methodology to the exclusion of everything else, I fear that there would have been greater financial instability that weekend. When we make these decisions, I have to take into account a range of factors, including...
So if I can, I know I'm nearly out of time, but if the chairman will let me pursue for just a minute here. Are you telling me that there are other factors that weighed against the other bidders that weren't there for JP Morgan Chase, and that's how it is that you went with the biggest bidder, even though the biggest bidder, by your own GSIB scores, increases risk to the financial system?
What I'm saying is that a GSIB score approach to that factor that weekend would not have been a wise one.
Because that's why we're here to exercise oversight. You can't just say, I decided on something else without putting some facts behind that.
The GSIB score framework is not part of the framework that is listed there. There's a number of factors there. We're taking into what's very important, especially when there's a failing bank situation, is that the government act in a coordinated and timely manner, that we minimize losses to the DIF.
You had one job to do, and I appreciate, I'm out of time here, and I appreciate your forbearance here, Mr. Chairman, but I do want to say, the single biggest threat to the U.S. banking system is concentration. We're all pushing harder for merger guidelines so that we don't get more concentration in the banking system. You are the one person who was supposed to use judgment on the question of, as between multiple sales, which one was the right one to go with and which one presented more risk to the banking system. According to your own metric, you chose the one that gives us more concentration in the system. I am very troubled by that decision.
Senator Tillis from North Carolina is recognized.
Thank you, Mr. Chairman.
Thank you, Mr. Chairman. So in its postmortem of the Silicon Valley Bank collapse, the Fed found that legislation passed out of this committee in 2018 led to weakened rules for big banks that were major contributors to SVB's failure. The lessons, I think, are clear. Regulators need to strengthen bank oversight, and Congress must reinstate stronger rules. And here's a place to start. SVB, Signature Bank, and First Republic all lobbied Congress to weaken the guardrails, preventing them from making risky bets with depositors' money. And then, surprise, surprise, these executives took risks to boost their short-term profits, gave themselves huge salaries and bonuses and stock options, and when they crashed their banks, they walked away with fortunes. That's why Senators Cortez Masto, Senator Hawley, Senator Braun, and I introduced a bipartisan bill to ensure that when executives crash their banks and threaten the banking system, those executives are forced to give up their fancy compensation packages. Professor Lin, you are an expert on corporate governance and financial regulation. If our failed bank executives clawback act, which applies to failed banks no matter how they are dealt with by the FDIC, had been the law of the land when SVB failed, would it have applied to SVB executives?
Yes, I believe so, Senator.
And would it have applied to Signature executives?
I believe so, Senator.
And would it have applied to First Republic executives?
I believe so.
All right. SVB, Signature, and First Republic were resolved by the FDIC through different processes using different statutory authorities. To make clawbacks effective, we have to give regulators broad authority to claw back executive pay whenever banks collapse, regardless of the specific process that the FDIC uses to pick up the pieces. Now, unsurprisingly, bank executives hate clawbacks. They want to keep on taking risks with zero consequences. Professor Lin, if our banking regulators had the choice whether or not to claw back executive compensation after a bank failure, would you expect Wall Street to exert significant pressure on them not to use that authority?
Yes, I think that's a real possibility.
You know, it is clear that giving regulators power to do something is not always enough. Congress needs to force regulators to use it, which is what Senators Cortez Masto, Hawley, and Braun's and my bill does. Now, in its review of the SVB collapse, the Government Accountability Office found that, quote, in the 5 years prior to 2023, regulators identified concerns with Silicon Valley Bank and Signature Bank, but both banks were slow to mitigate the problems the regulators identified, and risk built up over time. Professor Schooner, if regulators had had the authority they needed to claw back compensation from SVB executives, would it be reasonable, in your view, for them to consider the executives' actions and pay since 2018, when the regulators first began warning SVB about its risky practices?
Senator, I think that would be very reasonable. Incentive arrangements often rely on short-term metrics that it takes the long term to determine whether those involve excessive risk. So I think giving regulators the opportunity to capture that kind of excessive risk-taking is reasonable.
Okay, that's very helpful. Thank you. You know, Congress needs to put in place tough rules that make sure that executives pay up when their actions lead directly to a bank failure. And in order for us to do that, the regulation needs to do three things: force regulators to claw back compensation from the executives who are responsible for the failure. Second, apply in all cases of bank failure, no matter how the particular form comes out. And third, allow up to 5 years of compensation to be clawed back. My bill, with Senators Cortez Masto, Hawley, and Braun, achieves all three of those, and I hope that this committee will take action on it soon. Thank you, Mr. Chairman.
Thank you, Senator Vance. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. Fentanyl is fueling the most severe drug crisis our country has ever seen. In 2022, synthetic opioids like fentanyl were responsible for 75,000 deaths, more than 2/3 of all drug overdose deaths last year. Fentanyl is now the leading cause of death among Americans 18 to 45. China is the leading supplier of the chemical ingredients called precursors that drug cartels use to produce fentanyl and other synthetic opioids. China also plays a major role in laundering money for the cartels. Assistant Secretary Rosenberg, you are responsible for leading and coordinating anti-money laundering policy. Now, Treasury has caught a number of Chinese companies that were providing fentanyl precursors. Were any of these Chinese companies using cryptocurrency in their illegal drug transactions?
Thank you, Senator, for the question. Unfortunately, that is a mode that some of these precursor manufacturers and illicit drug organizations have used, the receipt of Bitcoin payments in wallets, cryptocurrency wallets.
Okay, so we're talking about these Chinese companies that are supplying the precursors to fentanyl, and they're getting paid in cryptocurrency. And you have to ask why this would happen, because crypto is supposedly banned in China. But new research from the blockchain analytics firm Elliptic shows that more than 90 companies based in China are raking in tens of millions of dollars worth of crypto, selling these fentanyl precursors. The number of crypto transactions associated with Chinese fentanyl brokers increased by 450% just last year alone. So, Assistant Secretary Rosenberg, why are drug suppliers and cartels increasingly turning to crypto for large-scale drug sales and money laundering?
Thank you, Senator, for the question. The reason why they would find this appealing is the same reason that other financial criminals would find it appealing, which is to say there's an element of pseudonymity that they seek in using this kind of payment mechanism. Also, you're able to, unfortunately for these purposes, process a large value, financial value across
Lots
the
of
border.
dollars worth of transactions.
Of Bitcoin in this instance, right? A large amount of a high value of such currency across a national border. And if you can achieve a person-to-person transaction or decentralized transaction, then you're avoiding the kind of scrutiny, know your customer, financial disclosure that you would get if you used a more traditional financial institution. So those anonymity-enhancing features are generally what financial criminals that you're noting here find attractive.
Okay, so they're using crypto. This is their payment of choice for these fentanyl dealers. This is looking good for them. And
it is one. Unfortunately,
okay.
There are others, but it is certainly one.
But this is one that they're focused on here. So Elliptic's research found that these 90 Chinese suppliers sold enough. Let's talk about the volume. This group sold enough precursor drugs in exchange for crypto to produce $54 billion worth of fentanyl pills. That is enough fentanyl to kill nearly 9 billion people, all paid for by crypto. When one of the companies was asked whether their Mexico-based customers paid in crypto, they replied that the cartels, and I'm going to quote, always use Tether or Bitcoin to pay. It is no problem. Now, the Office of National Drug Control Policy has identified crypto as, quote, central to the rise of drug sales in the United States. Senator Marshall and I believe that Congress has talked about fentanyl long enough. We propose to do something to fight back, and that is why we are reintroducing our Digital Asset Anti-Money Laundering Act, which closes loopholes in our anti-money laundering rules and cuts off drug suppliers and cartels from using crypto to fuel their illegal business. Assistant Secretary Rosenberg, will closing the holes in our anti-money laundering rules give regulators stronger tools to address crypto's use in the fentanyl trade and at least help cut off payments from drug cartels to Chinese drug suppliers?
Yes, I'm certain that will help, and I hope that we will be able to encourage some of our foreign counterparts, other jurisdictions, to do the same, which would go a long way in helping as well.
Thank you. Crypto is helping fund the fentanyl trade, and we have the power to shut that down. It's time. Thank you. Thank you, Mr. Chairman. So the tax code is a powerfully important policy tool. It raises the revenue that we need to fund investments in hospitals and bridges and clean air. It determines whether or not the wealthiest must pay their fair share for these investments, and the tax code itself is a social insurance system that helps struggling families. So today I want to talk about two ways to make our tax system fairer: restoring the expanded child tax credit, or CTC, and making it easier for families to actually claim that credit. For decades, the CTC has helped families with the cost of raising children. And during the pandemic, as many of my colleagues have talked about, Democrats expanded the CTC to make it more generous and to ensure that the poorest families would get a check from the IRS when the CTC exceeded the amount that they owed in taxes. So, Ms. Lester, I thank you for joining us today. I know you've talked with a lot of people, but I just want to understand, you're an Ohio-based mom, right, with 2 daughters. How old are your girls?
Yes. My oldest is 3.5, Olivia, and then the youngest just turned 1, and her name's Emma.
Ah, great names. What a blessing. Can you just say a word about how the child tax credit has made a difference in their lives?
I received it just for Olivia, but it definitely did help us cover a lot of different costs. Like I had given an example of, I took my first ever family vacation. That helped towards the cost of that. I wanted my daughter to see, the ocean. I'd love her to experience things that I never got to experience growing up. And I think that, travel and experiencing different cultures is part of that to expand her horizons.
That's great. The expanded child tax credit lifted nearly 3 million children out of poverty, and it slashed the child poverty rate almost in half, the largest single-year decline on record. We need to restore the expanded child tax credit and make it available again to mixed-status families. But we also need to make it easier and less expensive for families to file their taxes in order to claim it. So, Ms. Lester, let me ask you, how did you file your taxes, including the claim for the CTC? Did you have to pay money to file your taxes?
Yes, I use like an online software program. It's called TaxAct. It's like TurboTax. I've been using that for well over a decade.
Do you remember what you paid for it?
This past year, yes, I had to pay like about $45 for federal and then $45 for state. I try to file the state myself so that it's free, but something went wrong this year, and so I had to.
Okay, so $90 in order to get your child tax credit. This is all too common. The Tax Act is actually part of a public-private partnership called Free File, which was supposed to allow 70% of taxpayers to file for free, but it in fact only serves about 2% of filers. Instead, the average individual, you're at least below average on this one, the average individual spends about $140 to file their taxes. Now, those prices help the likes of TaxAct and Intuit and these other for-profit outfits, but they are also a big reason that over 10 million low-income Americans don't claim the hundreds of dollars in tax benefits that they are legally entitled to every year, including the CTC and the EITC. Our current tax filing system isn't working, and that is why just last month, the IRS announced that it will be launching a new tool next year that will allow taxpayers to file for free directly with the IRS. Ms. Lester, I want to ask, if the IRS were offering a free tool that you could use easily and securely to file your taxes, would you be interested in using it?
Yes, I would probably feel a little more competent in using their program than a for-profit company. That's the reason why I've stayed with the one for so long is concerns of security.
Yep, good. And of course, save yourself some money there.
Right.
So along with announcing the direct file pilot for next year, the IRS released a report which clearly showed that taxpayers want a direct filing tool and that the IRS is able to provide one. So it's great news that the IRS is acting. Congress needs to step up too. We should restore the expanded CTC and fully fund the IRS so that it can keep providing and improving services like direct file to ensure that American families get the refunds they're owed. That's the kind of tax reform that American families deserve. Thank you. Thank you, Mr. Chairman.
I'm going to go to Senator Tillman.
Senator Warren from Massachusetts is recognized.
Thank you very much, Mr. Chairman. So throughout history, when rumors take off that banks may not have enough money to cover all their deposits, depositors rush to withdraw their money. FDIC insurance was designed to reassure depositors that they will be fine, but the $250,000 cap means that bigger depositors, which can be small businesses, big businesses, nonprofits, are left exposed. These folks depend on their ability to access their money to cover their payroll, to cover rent and other expenses. So when they hear even a rumor of trouble, they rush to withdraw their money, causing a run that threatens the bank's survival. Now, why do people listen to rumors of bank failures? Why not? The cost of moving an account from one bank to a bank that is more secure is very small. So if people really are at risk for losing their money or even temporary access to their money, why not get out while the getting's good? Ms. DeVito, if a crisis hit the banking system, does history suggest that a depositor, even a very big depositor, needs to worry about whether they will be able to access their money if it's at a community bank?
More often than not, all failed bank depositors are eventually made whole through resolution or once a bank's assets are sold. That can take time, sometimes weeks, months, years, for depositors to get that money back. And that kind of lag and general disruption can be incredibly harmful to businesses, especially larger depositors who need access to their funds. So depositors, large depositors at smaller institutions would be right to worry.
Okay, so it's not a huge risk, but it's a real risk. And since 2007, about 7% of failed banks had uninsured depositors that have still not fully recovered their money. Now, Ms. DeVito, what about the giant banks, the too big to fail banks? Does history suggest that a depositor should worry even a little about deposits in excess of $250,000 FDIC cap at those giant banks?
No, the federal government has demonstrated that it will take actions to backstop depositors at the biggest banks, no matter the financial cost. It then does recoup those losses by levying increased assessments, but those are spread across all banks. So this has created a system of implicit, unlimited coverage for the largest banks.
So what that says is that when depositors trigger a run, they're actually acting rationally. These businesses flee to the place that they know their money will be ready for them for sure 100% when they need it. And while my community bank down the street and JP Morgan Chase may have the same official $250,000 insurance cap on paper, the fact of the matter is, if the two go underwater, the government's throwing the unlimited insurance life vest to JP Morgan Chase. Depositors run to the giant banks because they know the government will bail them out. So, Mr. Frazier, are the too big to fail banks paying for this extra measure of insurance?
So from a transparency standpoint, I can speak about my bank and how much we pay into the system. And, you know, we pay on average 7.7 basis points is, I think, our premium that we last calculated. I know that all the institutions are subject to the same schedule of calculations related to the risks that are in place. And I'll get to your answer in a minute. And whether or not that deposit insurance scheme fully captures those implied guarantees and risks, it's beyond my ability to assess.
Look, you just said it, though. Everybody's getting charged the same amount for these $250,000 caps, only it turns out that the too big to fail banks are getting a whole lot more than a $250,000 caps. And what I'm worried about here is that we're seeing the too big to fail banks get unlimited insurance without paying for it. And they are getting that benefit at a cost to the community banks. How do we know that? In the aftermath of the SVB crisis, the 25 biggest banks gained more than $100 billion in new deposits in the days after the SVB collapse, while the small banks, the ones below that level, lost more than $100 billion in deposits. So how do we make sure that FDIC insurance isn't structured to give a free bonus to the too big to fail banks? Ms. DeVito, if we could provide a little more reassurance to the business and nonprofit depositors that their money will be protected by raising the insurance cap in the smaller banks, do you think they would be less likely to flee those smaller banks whenever they hear rumors of stress in the banking industry?
Yes, ma'am. That's generally how deposit insurance works. The more money you know is safe, the less worried you are about it being at risk, and the less inclined you are to engage in a bank run.
Well, I think it's time to reform the deposit insurance system so it isn't just another handout to the big guys. I think we should do three things. First, raise the FDIC limits so that banks can bank with so that businesses can bank with community banks without the threat of business interruption during a crisis. Second, make the too big to fail banks and the banks with the highest levels of uninsured deposits cover more of the cost of ensuring the stability of our banking system and the FDIC insurance fund. And third, tougher oversight to ensure that banks don't take advantage of this additional insurance and engage in riskier behavior. Thank you, Mr. Chairman.
Thank you to the witnesses today. Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So in 2010, Congress passed Dodd-Frank to make banking regulations tougher and to avoid future bank collapses. And very soon after that, bank CEOs started lobbying for weaker rules. Now, Chair Powell, you also lobbied for weaker rules. When President Trump first nominated you as Fed chair in 2017, you testified, actually in this very room, I think, that you intended to, quote, consider appropriate ways to ease regulatory burdens for the banks. And when I asked you if there were any rules at all, that you thought ought to be made stronger, do you remember what you said?
I think I pointed to the net stable funding ratio.
No, actually, that's not what you said. You said, honestly, Senator, I think they're tough enough. You couldn't point to anything you thought should be tougher. In 2018...
In the event we strengthened the net stable funding
ratio.
ratio.
In 2018, you supported Congress's weakening of those rules. You led the Fed in hacking away at one rule after another. According to the Fed's own analysis of the Silicon Valley Bank failure, you weakened the rules in multiple ways. You reduced capital requirements. You weakened liquidity risk management. You skipped out on using enhanced stress testing for banks with tens of billions of dollars in assets and more. And the result was that the second, third, and fourth largest bank failures in U.S. history, which together required $23 billion in bailout money. In fact, you now hold the record. In a single year, the FDIC has been forced to rescue more giant failed banks on your watch than any Fed chair in American history. Chair Powell, do you agree with Vice Chair Barr's conclusion that the Fed bears a big share of the responsibility for the failure of SVB?
I certainly think that our supervision has been shown to have been lax in not being assertive enough. I think that the supervisors saw the right issues but weren't forceful enough in hindsight. And I think that's certainly a fair conclusion.
Okay. So those regulations were weakened. Those supervisors were clearly asleep at the switch for more than 5 years under your watch. And I'll just say it again. This is exactly why I opposed your nomination in 2017. The decisions that you made, the votes that you took, and the things that you said helped caused this mess. And when you were up for reappointment in 2021, I opposed your confirmation because I believed that your continued leadership would be dangerous to our financial system. And the Fed's own report confirms that. So yesterday, Chair Powell, this committee voted on a bill to help hold CEOs accountable when their actions blow up banks. At the Fed, you are the one who lobbied, who drafted, and who voted for weaker rules, and you were ultimately responsible for the team of Fed supervisors who fell down on the job. Do you take responsibility for your role in these bank failures?
So I think we learned some lessons from the bank failures, and the main responsibility I take is to learn the right lessons from this and to undertake to address them, so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system. That's not supposed to happen, and we need to take appropriate steps to make sure it doesn't happen again.
So I just want to make sure I understand what you mean when you say you take responsibility. Do you take responsibility for your actions that led to the failures of these banks?
Yeah, I think the question of what happened, supervision was at fault. That's both at the board and at the reserve banks.
And are you ultimately responsible for those supervisors? Are you
Actually,
in charge here?
under the law, the vice chair for supervision has
Okay, so you
has
take
sole
no
authority.
responsibility on
I didn't
that.
say that.
Well, that's what I'm trying to ask.
That's
I'm trying
not
to
what I said.
understand what you take responsibility for.
I take responsibility for addressing the situation appropriately.
That's talking about
that's
going
my
forward.
Focus. That's my focus. It's going forward.
Yeah, well, that kind of sounds like not taking responsibility for what you've done in the past. You know, a month ago, we had the CEOs of the banks that exploded in here, and each of them had scooped up huge bonuses, and each of them said they plan to keep every penny of that money. And now we have the chair of the Federal Reserve who led the charge to weaken bank regulations, who oversaw the bank supervisors who failed miserably to hold these banks in line. And again, the accountability is zero. Our banking system is broken. $23 billion in bailout money, and there is no accountability for those at the top. And once again, the people who didn't cause the mess are forced to clean it up. We need significant changes here. Mr. Chairman, I yield.
Take the time you
Thank
want.
you, Mr. Chairman. So too many families walk a tightrope to try to make ends meet, and that is why Congress established the child tax credit, to try to help families pay for essentials like diapers and daycare. During the pandemic, Democrats increased the value of the CTC and expanded access to more low-income families. The result was one of the most effective anti-poverty programs ever. A record 3 million children lifted out of poverty. Child poverty slashed in nearly half within the space of a year. But congressional Republicans continue to insist on what they call work requirements for the CTC and other critical programs. I call these unworkable requirements. This is an old trick of using a maze of red tape to deny families the help they need while not actually promoting employment. Now, Mr. Dattagupta, you're the director of the Center for Law and Social Policy and an expert on poverty. So tell me, have work requirements, when applied to the CTC, to Medicaid, to SNAP, to TANF, whenever they've been applied, actually helped families find good jobs and escape poverty?
No. Data show that the CTC refundability doesn't stop parents from working. I just want to remind folks it's completely different than the old pre-TANF AFDC program. It does not phase out dollar for dollar at some point. You do not have less access to health coverage after a year as you did then. So look, the main effect here of work requirements is to make it harder for people to access benefits. We tried this in Arkansas with Medicaid under the Trump administration, and there was no impact on employment, but they did kick 1 in 4 adults off of health coverage, even though 95% were either already working or qualified for an exemption.
So say that again. So they put work requirements in place, and the consequence was not to boost the number of people who were working at all, but you did lower the rolls of people who got the benefits that they were legally qualified for. And you said what portion lost their benefits?
1 in 4 adults.
1 in 4. So all of this red tape has not helped people find work, but it has cost millions of people the help that they need and wasted the time of millions more. And it's not just families that get buried under this mountain of paperwork. The government actually has to administer it, and that's not free. So, Mr. Datta-Gupta, in addition to costing families their benefits, can you tell us a little bit about what work requirements actually cost the government?
Yes, you're right, Senator Warren. Administering these complex rules inevitably costs the government money. So again, if we look at when the Trump administration tried to apply work requirements in Medicaid, the Georgetown Center for Children and Families estimated costs for states that were interested, or in the case of Arkansas actually implemented the program, and they found that the costs varied from tens of millions a year to hundreds of millions a year in just implementing the work requirements. So this is not a path toward simplifying.
Okay, so work requirements don't actually promote work, but they do cost millions of Americans benefits, and they cost the government hundreds of millions of dollars to administer. But there is one group that actually profits from these work requirements. Obviously not the government, it's obviously not the people who need the help, but instead it's the for-profit contractors who are hired to administer these programs. Maximus, for example, has contracts in more than half of the states to administer eligibility rules for Medicaid, SNAP, and TANF. And they have raked in billions of dollars, shoving families off their benefits if those families can't run through the maze. So, Mr. Datta-Gupta, in your opinion, do work requirements help anyone besides the private contractors that get paid to administer them?
Overwhelmingly, no. They distract from a lot of the things that actually boost incomes, improve health, and other outcomes. We talk about the 90s often, the 96 welfare law. Well, we need to acknowledge the big boost in the earned income tax credit, child care spending, raising the minimum wage, running a tight labor market, all of which I think were much more effective. Yes, private contractors are paid millions of dollars to administer these programs and have been busy lobbying Congress and states to expand the requirements in order to increase demand for their services. That money could be far better spent directly supporting families.
I agree with you. We need to stay focused on policies that actually help struggling families and invest in our economy. And that means restoring an expanded child tax credit and opposing Republican efforts to try to tear another hole in America's safety net and use a maze of red tape that has been proven a failure every time it's been tried. Families need us to get this right, so I hope we can get this done. Thank you, Mr. Chairman.
Thank you very much, Senator.
Thank you, Mr. Chairman, and thank you very much for holding this hearing today. Such an important topic. The housing shortage is a national emergency that lies at the root of what makes buying or renting a home the single largest line item in most families' budgets, so wildly unaffordable to too many Americans today. We know how to solve the problem. We need to build more housing. And not just more housing, but more of every kind of housing. Housing for seniors, housing for people with disabilities, housing for veterans, housing for families with children, housing for single people, housing for first-time buyers, and on and on. That undoubtedly will require new housing development and construction, and I believe we need serious federal dollars to help make this happen. But there are also things that we can do to make the most of the construction that we already have. For example, towns all across this country are taking a look at their unused non-residential properties like office space or long-abandoned public buildings to see if those spaces could better be used to serve their communities as housing. Dr. Schutz, you have extensive experience studying the housing market. Now, property conversions may not work everywhere all the time, but we are seeing communities successfully using housing conversions to create accessible and affordable housing for some groups. Are you seeing this as a way to produce more housing for older Americans, for people with disabilities, and for other groups?
Absolutely. Conversion of non-residential buildings to housing can add substantial amounts of housing. If we look at cities like Los Angeles, for instance, the downtown converted a lot of empty office buildings, and they work really well for accessible units because they're already tall buildings equipped with elevators, so they can work really well in some contexts.
Yeah. You know, I want to say we're doing some of this in Massachusetts right now. Over the last few years, we've seen creative projects to convert existing non-residential construction to homes for older Americans and for the broader population. In New Bedford, a 114-year-old textile mill is being converted into apartments for lower and middle income adults aged 55 and older. In Salem, in Salem, 2 century-old Catholic schools are being converted to a mixed-income apartment for seniors and artists. And earlier this month, Boston Mayor Michelle Wu announced a bold pilot program to immediately create residential housing out of unused office space. And there's a lot of it, with about 1 in 5 of every commercial office buildings in downtown Boston currently vacant. Federal investment in converting formerly non-residential properties into housing could help more communities expand their housing supply in a way that fits the needs of target populations, like older adults who need accessible and centrally located homes. Accessory dwelling units, or ADUs, another tool that communities can use to get the most out of their existing construction. These units tend to be on the smaller side, something that homeowners can build on their own property and then use it as rental housing. Think of a mother-in-law unit on the back of the lot, or maybe an efficiency apartment over a garage. Dr. Schutz, could you say a word about how accessory dwelling units help address the housing shortage, especially among older adults?
Accessory dwelling units can fit in a couple of ways. They can provide a space on the property for a caretaker to live, or they can provide a space for adult children to move in. I would point to both California and Utah as states that have done a lot to push making accessory dwelling units easier to build at the state level.
Ms. Cannington, would you like to add to that? You seem engaged in this conversation.
Thank you so much, Senator. I just want to add the importance of both a carrots and sticks approach to the affordable, accessible, and inclusive housing crisis that we have. It is essential that we have accessibility requirements that accurately reflect the needs of the growing disabled and older adult population. But the bottom line is, without incentives, the developer field will only continue to see access as a compliance issue. But what we know is that access is an opportunity for everyone to thrive at levels that we have really never been able to fully realize in this country.
I think that's a really powerful point here. You know, this is something where my view on this is more. We need more. In the last few years, several towns on Cape Cod have agreed to reform their zoning laws to allow for the creation of ADUs to boost the supply of year-round housing for residents. Local advocacy groups have stepped up to provide modest financial incentives and practical assistance to homeowners to help them get ADUs in place. I get it. ADUs and conversions may not work everywhere. Every community's housing stock is different and particular needs are different. And there's no getting around the need for a major federal investment if we want to close the housing gap. But we can also help move the needle with more targeted federal investments that support and expand communities' efforts to boost their housing stock and to ensure that everyone, and I want to underline everyone, has access to safe, accessible, and affordable place to live. Again, thank you, Mr. Chairman.
Senator Warren, thanks very much, and thanks for being with us today. I'll wrap up by saying that I want to start by thanking each of our witnesses for
Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So insurance is there for natural disasters like floods or fires or storms, but climate change means that natural disasters are hitting harder and more frequently than ever before, and that's upending the insurance market and pushing insurers out of entire cities or even entire states. Without insurance, millions of families will be at greater risk for climate crises, and as whole communities lose access to insurance, the impact is going to be felt all the way through our economy. So let's talk about what some of the tools are to make some changes here. More than 2 years ago, President Biden issued an executive order telling the Federal Insurance Office, FIO, whose job it is to monitor the insurance industry, to examine the impact of climate change on private insurance in the United States. So FIO proposed to collect new data from insurers that would help the federal government better understand climate-related financial risks and to assess the potential for major disruptions of private insurance coverage across the country. So, Mr. Heller, would the data that FIO is proposing to collect help identify the threats to consumers and the economy from climate change? Would these data be useful?
Yes. Thank you, Senator Warren. Of course they would. We really need to understand with granular data where the industry is more exposed, where coverage offerings are shrinking and consumers become more exposed, and how risk transfer has changed over time. Think growing deductibles, these lower rebuilding costs. The pressure to keep information from getting to the public and to public policymakers, not just through FIO, but for years that we've seen this needing data but not getting the data. I mean, it's one of the reasons that the market crisis we're talking about today kind of feels so sudden, because we haven't been collecting this data that would have given us the tools to prepare.
Okay, so I can tell I'm talking to another data nerd. We want to get the numbers because they are helpful in helping us understand and assess risk. So if the information is important, we need the information. The president has asked for the information. Why don't we have it? This has been more than 2 years now. It turns out that the insurers and the regulators, state regulators, are pushing back on this. They say that collecting this information is unnecessary. I'm just going to quote them here, ill-advised and burdensome. And they've claimed that this data call would threaten so-called existing efforts that insurers have made to mitigate the risks of climate change on policyholders. They're even saying that the FIO and the Biden administration is strong-arming insurers and regulators to adopt climate risk mitigating strategies, and this could lead to higher compliance costs on insurers and higher premiums on Americans. Now, it seems to me here that the insurers and the regulators are going out of their way to hide information about premiums, claims, profits, and coverage. And without that information, consumers have no way of knowing if a hiked premium is justified or if it's just padding an insurance company's profits. So, Mr. Heller, you explained why we need the data. Why are the insurance companies resisting so hard on providing these data? What are they trying to hide?
Well, the insurance companies don't want us as the public, but also public policymakers, to really understand where things stand, because it allows them to do what we've seen in California, which is try to bully regulators and policymakers by saying, oh, we're going to leave if you don't do exactly what we want. If you don't deregulate this market, we're just going to walk away from you. The reason FIO made this request for data was because there was a black hole where all the data needed to be, where we could actually figure this out for ourselves and understand. Is it, as some are suggesting, it's just a problem of regulatory burden? Or is it insurance companies that did not do the preparation that we've been calling for 20 years? Is it the insurance companies that have been shifting around their books of business to protect their profits and expose more consumers? And that data call would reveal it. And that's why the insurance companies have lobbied so hard to keep it out of our hands.
Well, I very much appreciate the notion, and I'm seeing nods here, I take it, Ms. Norris, that you would agree with this, that we need the data, and the data are essential, both for making good policy and just evaluating what the insurance companies are up to?
Absolutely. We know that the insurance companies themselves have big data is out there. They're using big data to evaluate risk and decide what the premiums are. We should all be able to see the transparency.
All right. Well, I'm all for transparency in this. I appreciate the work that you're doing here. You know, this is just a reminder that the insurance companies have kind of been playing every part of this game. They've underwritten financing fossil fuels, and then they profit from selling protection from the impacts of those fossil fuels on climate. And now when climate risks are rising, they're trying to hang American families out to dry here and demanding either higher premiums or to get out of the market altogether. So there's a lot that's going on here that poses real risk to our economy. We need these data, and we need them now. Thank you. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator.
Thank you, Mr. Chairman. So the job of the SEC is to protect investors, not the fossil fuel industry. And when you were nominated 2.5 years ago, you said that giant corporations should not be able to hide their climate risks from investors. Without a strong climate risk disclosure rule, that is exactly what companies will continue to do. You have a mandate to protect investors. You have strong public support to do this, and I just want to say it is time for you to get this job done. But instead of spending the rest of my time fencing with you over when you're going to get this rule out on climate, and a strong rule on climate, I want to shift gears and talk about private equity. When private equity funds acquire a company, they and the companies they buy don't have to follow many of the rules that apply to publicly traded companies and brokers that are selling registered securities. So last month, the SEC finalized new rules that ban some, but not all, of private equity's most abusive tactics. Even so, after the rule change, private equity funds can still use registration exemptions intended for small businesses to raise trillions of dollars in the private market without filing public disclosures. That is a great deal for private equity, not such a good deal for investors. Again, SEC's job is to protect investors, but more and more people are at risk because they're sucked into markets that have weaker rules. Chair Gensler, do you have a ballpark estimate of how much money investors poured into the private equity markets, private markets, including private equity markets, where they're covered only by the weaker SEC disclosure rules?
The private funds total assets under management are about $26.5 trillion.
But how much was poured in last year? Do you know the number? I want to look at what's happening now.
I'm sorry, it's in the low single-digit trillions.
Well, does $4.5 trillion sound right to you?
We could get back, but it's probably in the ballpark.
Right. Okay, it's right. So do you know how much money investors put in the same time period into the public market where they got much better protection?
What you're highlighting is there's as much activity and in some years more activity in the private markets than the public markets.
Do you know what the number was last year?
I suspect you're going to tell me.
I am. It was $1 trillion. In other words, the SEC is carefully regulating a public market that handles only about 1 in 4 new investment dollars, while almost 3 out of 4 dollars are going into a private market that has much weaker rules. And those weaknesses are meaningful, even after the rules change. So, for example, private equity firms selling exempt securities don't have to report audited financial data to the public. Also, they don't have to disclose data showing that a company has lost all of its contracts or is getting sued for billions of dollars. Seems to me like that is an invitation for fraud. The SEC was built so that investors could have confidence in the honesty of markets, and now 3/4 of investments that are coming in are not getting those basic protections. So, Chair Gensler, how do you explain to the American people that the SEC, whose job it is to make sure that markets are honest, is standing by while private equity and the companies they own scoop up investor money without any public verification that the books are honest or that they aren't hiding huge risks. Isn't it your job to fix that?
Well, part of what we did in a finalized rule just a few weeks ago was require quarterly reporting on their fees, performance, and side letters, and then at least annual audits of those documents.
So let me just say here, Chair Gensler, since we are really pressed on time, I'm not disputing that you've done good things. I hope I said that right at the beginning. You have. But these look like two giant holes to me. And the question I'm asking is, how do you explain to investors who now represent 3/4 of all the new investment money that you're not even making these guys do an audited financial statement?
Well, actually, the rule that we just finished has an annual audit in it. So it's of these private funds, not of the underlying companies, but of the private funds themselves.
Well, let me just say, we're out of time. I really think that given the risks in this market, I appreciate what you've done. There's more still to do, and I hope we can do it as quickly as possible.
I thank you.
Thanks, Senator Warren.
I really appreciate your testimony. This is all enormously helpful, and I'm very happy to get it on the record. So I'm going to start with a round of questions, and then I will go to the ranking member, Senator Kennedy. So the American economy depends on American workers. And when more Americans are working, our economy can produce more. When production's up, families can spend more. When Americans are spending, companies can hire more. There's no question that more workers means a better economy for families everywhere. Getting Americans to work is especially important today. Right now, thanks to President Biden, the state of our economy is strong. We have more businesses looking for workers than we have workers looking for jobs. But to keep our economy humming along and to stave off inflation, it's important we get more workers into the workforce to fill those open jobs. So, Dr. Edwards, let me just ask you, I want to make sure we get this on the record. You're an economist who studies labor markets. Does access to affordable, high-quality care affect labor market participation rates?
Yes, both the availability of care and its price are related to labor force participation. There's a very clear elasticity of the relationship between the increase in price and the decrease in maternal employment.
Okay, so these two things are very closely linked. In other words, childcare is basic infrastructure for our economy, just like roads and bridges that we drive on every day to get to work. Now let's talk about what it looks like when basic infrastructure shuts down. Ms. Hardy, you are the co-founder and chief operating officer of Bobby, a company that produces infant formula. You're also, as you've described, a mother of 2 young children. Take me back to the early days of the pandemic. What happened to the child care that you and your employees relied on during those first few weeks?
It's hard to go back to that time.
Yeah, no one wants to.
But I'll do it.
Yes, but let's talk about it.
At the top of the pandemic, Bobby was literally just launching our business. We've been on the market for just shy of 3 years, right? So just to put that into perspective. And it impacted everything. I remember myself staring at a document. I was about to sign an office lease for our new business, and overnight, the whole world changed. All of our employees went home. We all logged onto Zoom, and right there, front and center, for the entire team to see was working parents trying to manage a kid, that little head running by in the background, and trying to focus at work. It was absolutely impossible for them to manage that tension. I myself had a teacher move into my home, and I ran a kindergarten for a whole year. Everybody at Bobby knows recess is at 11 a.m. and 1 p.m. at my house. But truly, this is not something that we can fix on our own as business owners. I pride myself on how we support parents, and I had a real moment of pause coming here today because childcare is the one nut that we cannot crack on our own. It is impossible for us to solve. So we need partnership. True partnership between business owners and the government to solve this collectively on behalf of working parents.
So that's a very powerful point, and I'm not going to drop this point. I just want to make sure I get everything else on the record here, but I'm I very much hear you, and we're going to talk about this. But I do want to go back. I was saying about the first few months of the pandemic, you talk about how everything changed overnight. You know, Americans experienced job loss on a scale not seen since the Great Depression. Over 20 million Americans were suddenly out of work, and they couldn't pay their child care providers. Hundreds of thousands of child care providers were at risk of shutting their doors. Mr. Hopkins is nodding about this because you remember these days. So this is when Senator Tina Smith and I led the charge to secure $50 billion with a B in emergency stabilization funding to help child care providers stay solvent, to try to keep workers on the payroll, and to handle the unexpected expenses that cropped up in trying to deal with the presence of this virus. So, Mr. Hopkins, I want to get your view here. You run a child care center in Virginia. How did the Pandemic Stabilization Fund affect your operation?
Senator Ron, let me start by letting you know that Hopkins House is an 84-year-old institution. We serve the range of Americans who need child care, from military to working to government folks. And the $1.2 million we received in federal funding represented 8% of our budget over the pandemic, but it was absolutely life-saving for the institution. Had it not been for this funding, we might have been among the 67% of child care providers in Virginia that had to close temporarily and permanently. These funds also enabled us to save 60 jobs in the child care industry that served the military folks from Fort Belvoir and the Pentagon, where some of our folks' children come from. It also allowed us to continue serving essential workers. We only closed for 3 weeks during the pandemic. And it was because of the funding from the federal government, we were able, as an institution, to continue helping the folks in this country who needed that help.
So this picks up on the theme that you had laid down, Ms. Hardy, and that is the importance of partnership between the federal government and, in this case, the providers of child care. And what I'm hearing you say is that the emergency stabilization funding was critical to keeping child care afloat during the pandemic. Dr. Edwards, though, I want to go back to labor market on this. Who suffered the steeper job losses during the pandemic, men or women?
Men lost about 13% of jobs, or that is to say 13% of men lost jobs and about 17% of women.
Okay, so more women, or as a percentage of workers in the workforce, lost their jobs than men, although it was both.
It was actually absolute and relative terms. More women in number, and a larger share of women lost their jobs in the first 2 months of the pandemic.
And 3 years later, have women workers overall recovered from the pandemic?
Yes, aggregate labor force participation and employment of women has recovered from their pandemic losses.
So did preserving the child care sector help ensure that workers, parents, particularly women, could get back to work as the pandemic waned?
You know, absolutely. In fact, the 3 million increase in labor force participation over the past year has been led by prime age women who are 25 to 54, and women with children under 5 are currently experiencing some of the highest labor force participation rates they've ever seen, far above their past peak.
All right. So access to quality child care and a strong economy go hand in hand. If child care centers had closed their doors in March 2020 and never reopened, a very real possibility at that point, our economy would have suffered serious long-term consequences. But because child care centers were able to stay open, parents were able to continue to work and rejoin the workforce when the economy opened back up. In fact, under President Biden, the U.S. economy has already added over 13 million jobs, and the unemployment rate has now hit a 50-year low. The emergency funding that we fought for helped save jobs, it helped save child care providers, and it helped save American families. And in a few minutes, I want to talk more about the details of this, but now I want to turn to my partner here, Ranking. All right, thank you, Senator Casey. So this week, millions of people will begin the process of choosing a Medicare plan through open enrollment. And one option is to stay with traditional Medicare. The other is to enroll in one of the many Medicare Advantage plans, or MA, as people often refer to it, which allows these for-profit health insurance companies to offer Medicare coverage. Now, in theory, these private companies should compete on the merits of the coverage they offer. Instead, big MA insurers with a war chest of advertising money use deceptive marketing tactics to lure seniors into the wrong plans. These companies exaggerate benefits. They claim that seniors can keep seeing doctors that are actually out of network, and they deceive seniors about how much they'll spend for out-of-pocket care. This is harmful to seniors, and that's a big part of what this hearing today has been all about. But I want to focus on a different point. It also drowns out competition from smaller insurers, even when they offer a better product. So, Ms. Hoagland, you are the CEO of Security Health Plan. This is a small community-based plan that participates in Medicare Advantage. So can you let's start with, how does your marketing budget compare to the marketing budget, for example, of United Health or Cigna?
Well, I obviously don't know the specifics of what that number might be, but I can tell you it's pennies on the dollar, fractional of what we would have to spend.
So everybody's out there trying to sell their plans to people, and some folks have got huge marketing budgets, and you've got a little sliver of that. So where do these big insurance companies get the budget for all of this advertising? Well, think about the structure here. The government pays MA plans a set amount of money per beneficiary. If a beneficiary is sicker, then the amount of money that the government pays can go up, and then whatever the insurers don't spend on care, they get to keep in profits. Now, as a result of this structure, giant insurance companies have built an entire business around making beneficiaries look as sick as possible by stuffing their medical records with as many diagnosis codes as possible, which means the government pays insurers more money. This is called upcoding, and government watchdogs have uncovered hundreds of billions of dollars in overpayments that result from insurance companies gaming the system like this. Ms. Hoagland, are Medicare Advantage plans permitted to spend the money they make off this upcoding on advertisements?
There's some amount of discretion in how the dollars can be spent. I do want to say I really do appreciate this question and how you framed it, and we would agree with you that we should be competing on the merits of coverage, not on the financial incentives. We certainly believe at Security Health Plan around care, not coding, and with care as the focal point.
And I am very glad to hear this, because my understanding is these plans can spend about 15% of the money they get from the federal government. These are your tax dollars at work on overhead and marketing, and nothing prohibits them from using the payments they get from gaming the system to actually draw more people in so they can keep that practice up. So the way I think of this is the Medicare Advantage plans that game the system get billions of dollars in overpayments. They then turn around and use that money to flood seniors with deceptive ads to lure them to join their plans. But there's one more twist in this. Once people sign up, once the companies make them look as sick as possible, these giant insurance companies refuse to deliver on the care that they actually promised. Now, in 2019, the Health and Human Services Inspector General found that Medicare Advantage insurers improperly denied payment for care in roughly 1 out of 5 claims, leaving seniors with piles of unpaid medical bills. And just 2 months last year, the giant insurance company Cigna used a computer algorithm to instantly deny payment for 300,000 claims, even though trained doctors are supposed to make those determinations. Ms. Hoagland, giant Medicare Advantage insurers are overcharging the government. They are peddling false promises, and then they're turning around and denying care to seniors and people with disabilities. So this is why CMS has taken steps to start to crack down on deceptive marketing and unfair denials of care. Do you think that the government's proposals go far enough?
No, I think there is more opportunity, and again, that's why we're here today. One of the things that we specifically have suggested around the marketing tactics that are currently out there and the additional payments that we see going to FMOs or middlemen is to really require some additional transparency so that it's very clear what all the dollars are and how they're flowing, and understanding who might be the bad actors, so that those can be addressed specifically. And then really thinking about, once we understand how the money flows, how do we put true maximum caps on some of these items so that they can't continue to be leveraged for financial gain.
Well, I very much appreciate it and very much appreciate your help in trying to expose these problems today, and appreciate the help from all of you. You know, it's simple. Responsible insurers don't lie and cheat seniors to make a buck, but it's clear that the big Medicare Advantage insurers aren't playing by the same set of rules as some of the smaller insurers. And I appreciate the steps that CMS has already taken, but they need to go further by making the Medicare Advantage insurers publish accurate data on patient care and out-of-pocket costs, and cracking down on practices like upcoding, doing all of this to the full extent of their authority. So thank you all for being with us today. And with that, for the information of the senators, questions for the record will be due by 5 p.m. on October 25th, and this hearing is adjourned. Thank you.